Now, to delve more into the topic, join me on the studio personal finance enthusiast, Dani Rachmat. Dani, thank you so much for joining me
Thank
today.
you for having me, as
So,
always.
one of the things that we're going to talk about, we have so many.
So many
I
things,
mentioned about
yes.
this shareholder composition or structure.
Yes.
So we already talked about this. Explain to me of what need to be considered on when we're talking about the company's shareholder structure. For example, let's say if I see a company and then 100% of the company is owned by a public, is that a good thing or is that a bad thing?
That depends on what kind of company that we are looking at.
All right.
But sometimes for a company, we really need the founder of the company who has the vision how the company will be and how their business is going to grow
Okay.
to still have the lead on the company.
All right.
But then maybe if the company is already matured, already big enough, and if it's already big enough, of course, there must be some institution owning the majority of the shares, like Apple. Then if the public own 100%, we can also see it like whether is there enough leadership in the company to drive where the company should go, how the business should grow, this kind of things.
So would you think that the company actually, is the stocks going to move if actually 100% of the public own the company?
Generally speaking, we can see that if it is owned 100% by public, especially retail, and no big institution with clear vision on how company goes, generally speaking, it is not that favorable for the investor because we will never know how the company will
perform after that. So which is going to lead me to the next one. So we're talking about shareholder composition, and of course when we get a stock, we want to see how it's going to move and how it's going to be priced. So that's where we're going to talk about the compound which
annual
is
growth rate.
CAGR. So let's talk about this for a second. The compound annual growth rates. Let's go to the formulation.
Let's stay here for a minute. Is there a return that would be required for an investment to grow from its beginning balance to ending balance? Assuming, this is the important part, assuming the profits were reinvested.
Oh, so assuming
yes,
it's
reinvested at the end of each period.
Interesting.
So if you were talking about 34 years, meaning that by the end of each year, so you receive dividend of the investment, you should reinvest that. So that's how you get the CAGR.
All right,
yes.
so let's take a look at the formulation. Oh, wow, this is an actual math right here.
Yeah.
All right. So
actually, it is very difficult to calculate it manually.
Yes.
But we already have so many
Some
tools.
calculation.
Yes,
all right. But in basic, this is the ending value.
This is ending value divided by the beginning value.
All right.
Power like 1 per number of years.
Number of years that we want to see go back.
See how the growth of the company.
So the only way we can see this if the company already exists.
Like for several years, like maybe 5 years.
So if it 1 year, then you're not able to see much on that.
So calculating the CAGR is different. Like you just divide the end value and the beginning value and then just -1. That percentage is obviously mislead. So CAGR is a more accurate way to get the sense how the company is growing.
Okay, so we're not looking. So right now, if we're looking at Microsoft, recently is around $423 per share, and in the beginning we have 0.65, which is if we just look at the numbers, wow, it's 123% growth. But again,
we cannot do this if you want to see how is the company grow every year.
We need to look at the CAGR. So, all right, so we have a calculation right here. The CAGR number is at 20%. How do we come up with that? So that's the 0.63.
$65. This is 34. Maybe we should make it clear that this is 34 years.
Okay, so this is the 423 divided by
0.65,
and then power to, this is an
actual or 34.
Or 34, we got the 34 from here. This is like me teaching my daughters. Like, you got the number from here. All right, so
-1 and all the formula, and you get 20.99%.
All right, 21%. So tell me, what do I need to understand about the 20.99%?
During these 34 years, this Microsoft stock grow like for each year, it grows like it grew 21% per year,
Okay.
compounded annually.
Compounded annually.
Yes, we often hear that you should, as an investor, you should befriend the power of the compounding interest.
Okay.
So this is the interest that is compounding this Microsoft, so that the company can grow from 0.65 to 423 per share.
All right. So we're not only looking from the 65 to the 423, but like we are actually
Yes.
gonna look at the CAGR.
And actually, getting this 21% in the stock market is quite difficult, quite hard.
All right. Really?
15% is already good enough CAGR for investing in the stock
Interesting.
market.
So we're gonna look at another one. Apple actually
Apple.
at the 21% from
A bit
34%.
higher compared to Microsoft in
Okay.
the same time period, 34 years.
Okay, so but I want to look at a more recent company, which is Tesla.
Tesla, yes.
At the
But
42.
we have to consider this.
Again.
It is only in 14 years.
Previously, we look at 34 years.
34
now we're
years,
looking
yes.
at 14 years back. Because
Because-
Tesla is a more recent
Yeah,
company.
most recent
So
company,
what's
yes.
the 42% tell us about this company?
Obviously, this Tesla during these 14 years, if you have money, you should invest in Tesla.
Okay.
Looking at this, because the compound annual growth rate is way higher, even double than compared to Apple and Microsoft.
So
then-
will I be able to gain that 42% in
Yes.
14 years?
That's my next part of
Okay.
a statement
Please.
that this CAGR only show you the historical movement of the price,
Right.
not the future forecast.
All right.
So it doesn't guarantee that you can get this
Much.
number.
Okay, in 14 years.
Yes, in the next 14 years. Or maybe if you want to look at 34 years, in the next 20 years, maybe the growth will not be this high.
As
Yes.
as
Because-
aggressive that one.
Other companies might have the same business with Tesla, because obviously this company is one of the what is it? The first companies in
Yeah,
EV
doing the
industry.
EVs. And then we're
Yeah.
gonna see if it's gonna slow down. It's probably gonna drop
Yeah.
to 20 or maybe
Or maybe
15.
the price of the EV vehicle lower and
then it's gonna
more
jump.
affordable. Yeah.
It can go higher, it can go
Yes.
lower. But again, this is the starting points that you need to
Yes.
consider. And again, disclaimer to everybody at home. Again, this is only for this is only information.
Yes.
This is only for discussion, something you might consider, something you might have not considered, but if you already consider it, good for you. Again, disclaimer on, go to your financial advisor for better advice on where you want to invest your money. All right, so before we go really quick, so I'm looking at the Tesla right now,
Yes.
back 14 years. So they already up here.
And
so
then
it go
go
down.
down here.
And then even then, CAGR, we still
still
coming at the
42% per year.
all right,
Yeah.
cool. All right, so we already talked about today's shareholder composition and CAGR. We're gonna have more.
So many things already.
What type of industry?
Yeah,
Yes.
yeah.
Almost done with this part, but a lot to look out for, and then all that good stuff. All right, we're going for a break. Thank you so much, Mas Dani, for
Thank you
being
for
on the
having
show.
me.
We are going for a break. When we return, we'll have our recap of the first session of trading in the Indonesian stock market. We'll be right back.